Okay. Good afternoon, everyone. We'll just give a minute for people joining. All right, what do you think, Dee Dee? We'll begin?
Thank you. We know it's a busy time of the year, but these are some important things that we wanted to draw your attention to regarding your estate planning and tax planning for your family. There's some things that you should consider before the end of the year and some general things that we want to draw your attention to for the future. I'm Doris Martin, and I'm the chair of the Trust and Estates Department at Garfunkel Wild. And joining me are our senior attorney, Kristen Walsh, in the middle, and on the other side is Bianca DeLeon, our junior associate, and we will be taking you through this program to educate you on planning opportunities. It will be recorded and available on our website. If you've registered for this, the materials will be sent to you after, and if you'd like to pose questions, please feel free to do so, and also to contact each one of us, and our information is at the end of the program. Estate planning has been challenging in recent years. We've had threats that the exemption would be drastically reduced that didn't come to pass. We've had proposals concerning our basic estate planning devices that have been under attack, which have not come to pass. We have an election coming up that will probably determine many of these things in the future. And there is a schedule change coming up that is quite drastic to the federal, state, and gift tax exemption in 2026. What we do know is that the sooner you become familiar with these concepts and consult an estate planning advisor, either at this firm or any other, or your financial advisors, and you'll certainly be seeing a lot of things in the news as date approaches when these drastic changes take place. The sooner that you take advantage of becoming educated and consulting someone, the more you will be better positioned for the future. So what we're going to do in this webinar is provide a brief overview of basic estate planning things that you need to keep in mind in general. And we will start with that, and Bianca will take us through the basics of what an estate plan consists of and considerations that you need to keep in mind, because these initial discussions and foundational matters are the roadmap for doing more sophisticated things, which Kristen and I will also explain in more detail as we go through it. So I'm going to turn it over to Bianca now to take you through the foundational matters of what's involved in estate planning.
Thank you, Dee Dee. Hello, everyone. An individual's estate plan is unique to an individual's family dynamics and assets. However, every estate plan should include the following documents: a will and/or revocable trust, power of attorney, healthcare documents, and maybe dispositions of remains form. Having these documents as a part of your estate plan ensure that your wishes are followed in the event of incapacity or death. As an added bonus, having these documents as a part of your estate plan ensures that the administration of your estate is less costly and time-consuming. As you may know, a will is a legal document that disposes of your assets upon your death. You appoint an executor who manages the administration of your estate. Just like a will, a revocable trust, sometimes called a living will, is a legal document that directs the distribution of your assets upon your death. However, unlike a will, a revocable trust avoids the need for probate, a process that, depending on which county you reside in, can take upwards to 4 months to complete. You retain access and control over your assets transferred into the name of your trust during your life, and upon your passing, your executor has immediate control over those assets and can distribute them to your beneficiaries. Another important component of your estate plan are advance directives. Yes, please. Advance directives include a power of attorney, healthcare forms, a living will, and possibly the dispositions of your remains form. A power of attorney is a legal document that allows you, the principal, to designate a third party, your agent, to handle your legal and financial affairs. Powers under a power of attorney include the ability for your agent to pay your bills, engage in various legal and financial transactions on your behalf, adjust your estate plan as needed, and much more. Executing a power of attorney ensures your chosen agent can handle your financial and legal affairs if you become incapacitated or for some reason are unable to handle your own financial affairs. Without a power of attorney, your family members would have to initiate a court proceeding known either as a guardianship proceeding or a conservatorship proceeding in order to manage your affairs. Another legal document that you should have in your estate plan is a healthcare designation form. This allows you to appoint an agent to make medical decisions on your behalf in the event you are unable to do so for yourself. In conjunction with a healthcare designation form, you should execute a living will, which is a document that allows you to specify your wishes and provide guidance to your agent regarding your medical decisions. Depending on your family dynamics, you may wish to execute a disposition of remains form. This form allows you to specify funeral instructions and appoint an agent to dispose of your remains.
And that document is especially important for unmarried couples so that you can allow your partner to be able to handle your funeral and dispose of your remains upon your death. And most of these documents are also very important in that type of family dynamic.
If you currently have an estate plan in place, the close of 2023 is a perfect opportunity for you to review your estate plan and determine if changes are necessary. Typically, changes are necessary if there has been a change to your family dynamics or to your assets. For example, if you were recently married, you may want to appoint your new spouse as your executor, trustee, healthcare agent, power of attorney. If you recently welcomed a child, you should appoint a guardian. If you are recently divorced, you may want to remove your former spouse from these roles. If you have concerns about whether a beneficiary can manage his or her inheritance, you may want to direct the distribution of that inheritance into a trust to protect the beneficiary. Before Kristen discusses incoming tax laws, I would also like to point out that you should ensure that your accounts are titled properly and that your beneficiary forms coordinate with your estate plan to ensure your wishes are followed. Kristen will now discuss the incoming tax changes that you should consider and that may affect your current estate plan.
Thank you, Bianca. And that's a good point about the beneficiary designations, because if you have beneficiary designations on file with a financial institution where you have your accounts or your life insurance policy, then your wills or trusts will not affect how those assets are disposed of, and the institution will follow the beneficiary designations on file. So very important to update those when you update your estate plan. So some incoming changes that we have to the tax laws. The primary one that we'll be talking about is the federal gift and estate tax exemption, and that is the maximum lifetime amount that you can give during lifetime or at death without paying federal gift or estate tax. That number is currently $12.92 million for 2023, so that's the maximum amount that you can give away without incurring gift tax, and that number is increasing to $13,610,000 for 2024. However, that number is scheduled to be about cut in half on January 1st, 2026, when the Trump tax cuts expire. So many people are looking to do estate planning to take advantage of the historically high exemption that we have right now. So the way that a wealthy person can take advantage of the historically high exemption is by making a large gift and essentially use up that exemption amount and remove that amount of assets from their taxable estate, as well as any future appreciation on those assets. So you have to be very wealthy and be able to give away at least more than what we think the exemption will be in 2026, which we estimate that it will be about 7 million unless the laws change before then, which it very well could be. The federal tax rate on amounts exceeding the federal exemption amount is 40%. And in addition, we'll talk about state estate tax in the following slide. But those whose assets exceed the reduced future exemption should look into different planning opportunities and take action before 2026.
And we can't emphasize that enough, that advisors, attorneys, account managers are going to get very, very busy in 2025 preparing for this date. And there are certain transactions that to prepare you to engage in, you should actually start planning in 2024. The longer you take to put these things in place, which could involve shifting assets from one spouse to another, and one spouse creating a trust for the benefit of the other, which we'll talk about in more detail, need to be done now. Attorneys and financial advisors will start getting booked up, and you cannot wait until the latter half of 2025 and expect the plan to be put in place with any degree of care or thoughtfulness. So we can't emphasize enough that if you do have assets that exceed, let's say, $14-15 million, and you would like to make a large gift, that you should consult your advisors starting next year in order to be positioned to take advantage of it in a thoughtful manner.
Sooner rather than later is best. Okay, so as I alluded to, we also have state estate tax to worry about in some states. Some states like New York have an estate tax, and New York does not track the federal exemption. We have a much lower exemption here. Our current exemption is 6.58 million, increasing to 6.94 million in 2024. In addition, unlike the federal estate tax exemption, where a surviving spouse can inherit the estate tax exemption of their deceased spouse, New York and Connecticut and some other states do not allow your spouse to inherit your unused estate tax exemption, so you have to do some estate tax planning there. And as New Jersey has no estate tax, however, they do impose an inheritance tax on beneficiaries that are outside your immediate family. So in New York, if your estate exceeds New York's exemption, even by a small amount, your estate is treated as having no exemption at all, and the entire estate, not just the excess over the exemption, is taxed. We call that the cliff. New York's top tax rate is 16%. So that's in addition to the 40% federal estate tax rate if you're looking at both taxes on your estate. Because of New York's cliff, for married New Yorkers, it is critical that each spouse's estate plan be set up to take advantage of New York's estate tax exemption. If the estate of the first spouse to die doesn't use that spouse's exemption by setting up a credit shelter trust, or sometimes called a bypass trust, the estate of the surviving spouse is limited to the survivor's exemption only. As a result, if the survivor's assets are over the New York exemption, the entire estate of the survivor is taxed. With proper planning, however, the couple can instead pass more than $13 million under the current laws to children or other beneficiaries free of New York estate tax.
And that trust that Kristen mentioned, the bypass or the exemption trust or credit shelter trust, doesn't mean that the surviving spouse won't have access to the funds. They can be the trustee and they can withdraw funds for their own benefit. But since it's a fund that won't be taxed in their estate, it really should be the last place that they draw on, because that trust, no matter what it grows to, won't be subject to tax in their estate. So this is a basic, plain vanilla part of most people's existing estate plans. But the key thing to think about is how the assets are titled. For example, if everything is in one spouse's name or jointly held, or one spouse has a lot of retirement assets which require additional forms to be prepared to make this planning work, it could be that when one spouse dies, you don't have enough assets in their name to take full advantage of their exemption, which is otherwise lost, resulting in the survivor's estate having more assets and going over that cliff. So the wills and trusts can set up these plans, but it's really important to review the assets periodically and work with your accountant and your advisors and your lawyer to make sure that each spouse's circumstances are considered and what can be moved between the spouses is put in place so that there's less legal work and costs later to make this doable.
That's right. And you could also include that type of credit shelter trust as an option so that you can have it in your documents just in case it's needed. And you're not necessarily cutting off your spouse's right to get the money directly. But it's a great idea to include it for, especially for state estate tax. If you are a New Yorker and your estate is hovering near the New York exemption, whether it's slightly over or slightly under, we know that the exemption will fluctuate over the years, and the exemption amount that will matter is the exemption amount in the year that you pass away. It's a good idea for many clients to include what we trust and estates people like to call a Santa Clause in your estate plan. This is an optional gift to charity that would occur only if it makes sense and results in a savings to your family. So it's the Santa Clause, or also called the New York Charitable Gift, says that if your estate is just over the New York exemption and a gift to charity, which is deductible for estate tax purposes, would result in a savings and avoid estate tax, then your executor or trustee would be permitted to make a gift to charity. And again, this doesn't take away from your family, but it does take away from the New York State Estate Tax Authority. So you can support a charity of your choosing or allow your trustees to decide and ultimately save money for your family. So in addition to the idea of using up your federal estate tax exemption or taking advantage of your New York estate tax exemption, we also have some windows opportunity in the Internal Revenue Code where annual tax-free gifts can be made up to what's known as the annual exclusion amount. So you can make annual tax-free gifts to as many people as you would like, and you can do that every year. And if you haven't done so in 2023, you can do that this month before the year is over. For future years, we recommend making annual gifts in the beginning of the year to allow future growth to accrue out of your taxable estate and in the hands of your chosen beneficiaries. So the annual gift tax exclusion amount for 2023 is $17,000 per recipient. And if you're married, you can double that amount, and it's $34,000 for a married couple. In 2024, the annual tax-free gift amount will be increased to $18,000. So that's how much you can give next year without needing to report the gift on a gift tax return or use up any exemption. And again, if you're a married couple, you can double that amount, and so that would be $36,000 next year. Direct education, tuition, and medical payments in unlimited amounts do not use up your federal estate and gift tax exemption. So in addition to making those annual exclusion gifts of the $17,000 or $18,000, you can also pay tuition, educational institutions, and medical providers directly for yourself and your family members in order to remove more assets from your taxable estate. So that's kind of a freebie that we have that really allows you to benefit family members who might need it for different reasons. Gifts can be made directly to a beneficiary. They can also be made in certain types of trusts. And also you can make a gift to a 529 college savings plan. For a 529, you can actually front load the plan with 5 years worth of gifts, and that supercharges the gifts by allowing you to get 5 years worth of gifts out of your taxable estate and allowing those funds to grow over time. In addition, making annual gifts to a grantor trust, and I'll explain that a little bit further, is another tax-free gift technique used by wealthy families. A grantor trust is a trust where you continue to pay the income taxes on the trust funds, on the growth on the trust funds. So essentially, you're making a gift to a trust, and as the trust funds grow, you can pay the income taxes. You're getting additional funds out of your taxable estate by paying the income taxes for the trust, and the trust is allowed to grow and grow outside of your taxable estate without having to pay additional taxes and have those funds reduced.
And that's a very, very powerful technique that we always recommend if the client can agree to afford it, that they continue to pay the taxes, which they've paid in the past on these assets, even though they've given them to a trust for the benefit of their spouse and or children. It is in essence a tax-free gift that the IRS does not recognize yet as a contribution to your family. You know, if the taxes can be tens or hundreds of thousands of dollars, depending on the amount you've given away, by you paying that tax on behalf of the trust, it's not depleted. It's very powerful. The IRS has tried to take it away in the past. So far, those efforts have failed, but it is the most foundational part of doing trusts also. There is also a way, if it becomes too dear in the future, given changes in your circumstances, that you do not longer want to pay the taxes on that trust, there are mechanisms, some of which are more complicated than others, for you to end that tax treatment, and the trust then will start paying its own taxes from its assets. But that is something that everyone should consider when they're doing a trust, if they're willing to take on that added benefit. And just to mention that New York does not have a gift tax, nor does New Jersey. Connecticut's gift tax is the same as the federal exemption model. So that is also something to be considered, that when you're making gifts. New York does have a 3-year rule, though, that if you make gifts in excess of these amounts and you're actually using part of your federal exemption up, if you die within 3 years, New York will count that as part of your taxable estate. So as people get older and they engage in planning beyond these annual tax-free gifts, that's something to consider also, that gift may be brought back, which unfortunately under the tax laws can actually increase your federal taxable estate, as opposed to having not made the gift at all. So it's a bit of a tightrope to walk on. I'm going to speak now about some of these trusts that you can use during your life to make gifts, either for the annual exclusion amount, because you don't want to give younger people or people who can't handle it the annual gifts outright, and also for larger gifts that go beyond that. So all of these gifts, if you don't want to make them outright to individuals, typically take the form of what's an irrevocable, meaning you cannot change the trust once it's set up. Irrevocable is sort of a misleading title, though, because there often are ways that you can give other people, or even with the consent of the people involved, and even under New York law, ways to change it. But let's assume that you go into it believing that you're not going to change it unless some circumstances come up that warrant it. You generally give up complete control and enjoyment of the assets transferred. You generally appoint someone who makes that determination, and there can be certain powers over that individual, either in your hands or someone else's, so that there is some degree of control in that way. And once you give the assets to the trust, they're out of your estate, and all the future appreciation is as well. So those trusts can grow well beyond what they're initially funded with, and the appreciation and accumulation remains outside of your estate. So the sooner you do them, the better. You can't be a beneficiary. You can be a trustee in some circumstances, but with very limited powers. And your spouse or your children or a trusted individual can also be the trustee in your place. There's many different types of these trusts. Some are more attractive when the interest rates are getting higher, as they are now, and some are more attractive when the rates are lower. So a lot of planning techniques that you may have heard about in the last few years, such as making loans to your children, creating certain kinds of trusts called GRATs, or sales to defective grantor trusts, are more attractive when the interest rates are low. But there are some indications that interest rates may stabilize within the next year, and eventually we will see another round where they're lower. You know, historically they've been much higher than they even are today, and they've been much lower in recent years. So for the future, there are certain ones that are more attractive today than others. The most common and popular technique of recent years, even though it is not something new, is called a Spousal Lifetime Access Trust, or a SLAT. And the idea is that while you may be reluctant to give away a large amount to take advantage of your exemption before it's changed, you can, if you're married, put it in a trust that's for your spouse's benefit. Your spouse can be the trustee, your spouse can be the beneficiary, and you could theoretically put the federal exemption of over $13 million starting next year into a trust for your spouse's benefit. And the idea is that as long as your spouse is alive and the beneficiary of that trust, and you're still married, that you are getting the benefit of the trust through the back door, because your spouse is the beneficiary of the trust. The issue that you need to face and consider in that is that if your spouse dies before you, which is why we try to have a crystal ball and look at which spouse might die after the other, you'd be limited in accessing those funds to taking a loan from the trust at whatever the interest rates are at the time. There can't be things put in place in advance to guarantee that, but you can have trustees in place who can respect that. Once the property is in the SLAT, as is with respect to any trust, it can grow and again won't be taxed as part of your estate. And if your spouse is the beneficiary, you will be taxed on the income to the trust, whether you like it or not. And that again is another way for the trust to go. But that is the way that became the most popular thing in the last few years, as people sought to take advantage of their exemption, where they didn't want to completely give it away, but put it in a trust for their spouse's benefit. Sometimes with people who are even more wealthy that want each spouse to take advantage of it, one spouse can create a trust with their exemption and the other spouse creates a trust with their exemption, but they cannot be identical. They cannot be what's called reciprocal. They can't be created on the same day. They should have different trustees. One does one in one tax year ideally, and the other spouse does it. It's critical that you start putting one in place now if you want to do two. Also, assets need to be switched around to take advantage of the exemption, and that needs to have some time to age if you need to put assets in a poorer spouse's name so that they can create the SLAT because they're best suited to being the one who creates it. So that's why it's important to start this planning in advance. But there is a possibility for one spouse to do it and use up their exemption, and then for another spouse to do it and use up their exemption. And sometimes people simply skip their spouses and put it directly in trust for their children. It depends on the circumstances. And certainly when there's a second marriage and the children are not both spouses, those considerations come into play as well. The second most popular, or probably the most popular actually above the SLAT, is if you have significant amounts of life insurance, you should not keep them in your name and be the owner of it if you have a taxable estate. This is something that becomes a surprise to people, that insurance proceeds are not exempt from estate tax. They are exempt from income tax, meaning that when a recipient receives the death benefit, they don't report that in income taxes, but they get added to that beneficiary's balance sheet. And if that beneficiary has an estate that exceeds the exemption amount, they will be taxed when that beneficiary dies. So while your spouse is typically the natural and primary beneficiary, if they have a taxable estate of their own or would as a result of receiving this insurance, it should not come to them outright. Much like the exemption trust or the bypass trust we spoke about earlier, the spouse can be the beneficiary, they can be the trustee, they can have a power to say how it goes when they die to the children or other people, and they can then enjoy it as if they inherited it outright if it's designed that way. You can of course put limits on them too, but generally we give the spouse lots of control and flexibility over those proceeds. You have to live 3 years from the date you do it. You have to give up all control. The insured cannot be a beneficiary. You can't have any powers over the trust. It's only your spouse or whoever the co-trustee is that can change the beneficiary, take out cash value. Sometimes people use insurance trusts as a savings device because the cash value builds up tax-free and you can someday take a loan. So you have to take that into consideration. If you were using an insurance policy as a retirement savings plan and you put it in this trust, you're going to be reliant, as in the SLAT, that your spouse is going to be the one that has access to it. And you need to consider, if your spouse isn't around, are your children as beneficiaries going to be willing to loan you money at that interest rate again? But again, this is a plain vanilla piece. And while many people have just term insurance that expires over time and serves a purpose while you have mortgages and children to educate, sometimes people do have whole life policies or joint survivor policies that only pay when both spouses are gone. And those should also certainly be in the hands of your children or a trust for your children's benefit. Something important about insurance trusts is that once the policy is in a trust, your payment of the premiums is considered a gift to the trust individuals, and they have to be given a notification of this. And you have to consider that if you are making annual gifts to your children, that you have to reserve some of that annual gift amount to cover your premium payments. So that may absorb some or all of them and reduce your ability to make other gifts that year within that annual amount that Kristen spoke of.
And while there are some administrative requirements to administering an irrevocable life insurance trust, I think it's relatively a pain-free way to, reduce your taxable estate because, typically, unless, as Dee Dee said, you're using your insurance policy as a retirement fund, you're not going to be accessing the life insurance while you're alive anyway. So giving it to a trust won't be so painful as giving away, other assets to a SLAT or something like that.
In addition to the SLAT and an insurance trust, there are many other trusts, some of which get even more complicated and depending on your financial circumstances may warrant being included or not in your estate. And they are dependent to a great degree on what the interest rate is. So some things that haven't been in favor over the past few years are now back in favor. Something that we used to do a lot of and then stopped as interest rates increased and decreased and they became less attractive were qualified personal residence trusts, which are also to some degree a painless way to take assets out of your estate. You can create a trust and put your house and or a vacation home into it. You keep the right to live in it. You continue to pay the expenses. You continue to deduct whatever deductions you get from real estate taxes. And as long as you live a certain number of years, the home is not included in your estate after you pass away. You do have to consider that someday you will need to start paying rent to the trust to keep it out of your estate. And that could be a greater amount than you may have anticipated. A home in the Hamptons that costs you, a certain amount to maintain would actually be rented for multiples of that number. And you have to be prepared that someday you have to get a broker to tell you how much your home would rent for and be willing to pay that amount in order to keep the trust's estate tax planning goal in mind. But it is a way that it doesn't really change your life during that initial rent-free term, and you do get to discount the value of the gift substantially depending on how long that term is that you can live in it rent-free. And of course, no one can kick you out of the house. You are guaranteed the right to live there as long as you pay the rent, or as long as your spouse, if they survive you as a beneficiary, they can let you live there because they are the beneficiary of the trust going forward. But the rent really should be looked at as a way, if you have enough liquidity, to transfer additional funds to your children because the rent is not considered a gift to the trust at that point. There's also, if you have a charitable interest and you have an asset that has increased in value substantially and you're reluctant to sell it because of the capital gains, you could contribute it to what's called a charitable remainder trust, where you keep an income stream, the asset sold without the tax being recognized immediately, so the funds can be invested without diminution. But at the end of the day, the charity does get a percentage of the assets depending on how the term that you keep for your own or someone else's benefit is maintained. But it does involve having a charitable intent or purchasing insurance to make up for the charity or what the charity will get at the end of the term. Other techniques that have fallen out of favor because they are not as economically attractive in a high interest rate environment are a sale to a defective grantor trust, meaning you sell an asset, you get an income stream back, and it's a way to reduce the gift essentially that you're making to your children. Grantor retained annuity trusts were very popular in the last few years, and that's where you put typically a portfolio. You keep basically what you put in the form of an annuity back to you, but the appreciation that's earned during the term of the trust is outside of your estate and is for your children's eventual benefit. But again, with lower interest rates, that was more attractive than it is in the current environment. And there's a flip to the charitable remainder trust, something called a charitable lead trust, where if you had an event in your life that has big income tax liability and you need a big charitable deduction, you could create a charitable trust that the charity gets an income stream from for a number of years, and you get a charitable deduction based on that income stream that could wipe out or reduce what you'd other have as a high tax year.
And your family can end up with the remainder there. So.
In addition, there are some income tax planning devices for charitable giving that you can engage in every year. First of all, if you do make significant charitable gifts, you should consider, if you have a need for a large charitable deduction in one year, but you're not quite prepared to decide what charitable recipients are, you can create what's called a donor advised fund. at a financial institution or a charity of your choice. You get an immediate tax deduction for the assets contributed for the charitable contribution, but you don't have to make the actual distributions to charity at any point in time. They may change that because these things are so attractive and there's a lot of money sitting out there in these funds that hasn't actually gone to charity yet. But as long as it's going to public charities, you can advise, quote unquote, the charity as to how to make the distribution. And typically those distributions are respected as long as the charity is a legitimate one. You can also name your children as advisors to the fund after your passing to involve them and encourage them to have charitable, planning in their own lives. And that's something that's very attractive. And there's been an explosion of those in the last 10 years. You can also give appreciated stock directly to a charity or to the donor advised fund instead of cash, so that you don't have to realize capital gains taxes on the sale of assets to free them up for your own use. So that's something that's attractive. Again, these things are all available on, if you check the website of your favorite charity, all these things can be explained, and it's very streamlined as to how to make those transfers. They're almost invisible. Something else that's also very important but can be somewhat complicated, and accountants can also feel that it's difficult to track these things, so they may discourage you, but it's worth considering, is if you have an IRA and you're now taking distributions, which are called your required minimum distributions, and you do make significant contributions to charity, instead of taking the money out of your own checking account, you can take it out of your IRA by having the IRA directly disperse funds to charity. You don't get a charitable deduction for that, but the advantage and the reason to do it is you don't have to report what goes to charity in your taxable income for the year. And you can give up to $100,000 of your required minimum distribution each year if it goes directly to charity. If you're a married couple, you could jointly do 200,000, and each of you can do 100,000 each, and your taxable income is reduced by that amount, which can produce a big savings if that's valuable to you. These payouts also would reduce your adjusted gross income, which is used by Medicare to determine the cost of your monthly premium. So it does have other beneficial ramifications to that. Again, it's the easiest way to make them is if there's a checking account attached to your IRA, so that you don't have to involve the advisors who are not suited to, sending certain amounts directly to charity, and that makes it a bit less complicated. But it's something worth discussing with your accountant and setting up, because it can take care of your charitable contributions and reduce your income taxes for the year, even though you're not getting a charitable deduction.
Okay. So that concludes our slides. We had a question come in before the presentation. Someone asked if there's a certain minimum amount that we would recommend to fund, with which to fund a SLAT. And to that, I would say that because the exemption is around 13 million, and we expect that it will be reduced to about 7 million in 2026, and you'll still have that 7 million to use then, that the amount that you contribute to a SLAT should be at least 8 or 9 million to take advantage of the higher exemption now. You agree with that?
Yes, and we can't emphasize enough that your estate plan is something that's a living organism, and you need to tend to it, make sure beneficiary designations are in order, take a look at it and see if something's changed. You've had one of those life events that Bianca described, something's changed in your finances, a parent passed away, you're inheriting money, you're thinking about moving to another state. It's a good idea as part of either income tax time when you meet with your accountant, or the end of the year if you want to prepare for the new year, to go through these things. Take a minute to call your advisors, to call us. We're available anytime to answer questions, and we like, once we've created documents, that the clients stay in touch and just check in with us periodically. We send out alerts. This presentation will be available to you if you've registered, and also on our website. And we're happy to just take questions from you. Any of us, our contact information is in the presentation. And thank you at this busy time of the year for participating, and we look forward to hearing from you as you have needs, and hopefully before 2026, when we're all going to have a very busy year preparing for that.
Okay, thank you, everyone.
Thank you.